And so that's why I think to put it more succinctly, I think that you should be intelligent about investing more heavily in lower risk things. But I do think that there is a place and an important place in higher risk things. And that's also it's a muscle you develop over time. Whether something ends up relatively lukewarm or something that you regret, at the end of the day, with things like that are higher risk, you learn, right? And then you can do better next time as long as you don't give up.
Yeah. Matt, if I could mention just from, I
Please.
guess we had a lot of real estate investors also coming from the MedcoShare side when we started up, and a lot of them would be asking, like, what are my returns? And it's a
Right.
startup, you're not getting returns, right? It's
Right.
basically the value, like you pointed out, it's 10x and it's 20x and it's 100xing. It's a huge difference with what you can do versus real estate, but you don't have that continuous cash flow, monthly cash flow. So for the real estate point of view, that's the big difference. But besides waiting for that company to go IPO, there are places when you get to say another round of funding, a Series A or a Series E or whatever, that there's websites now where people can sell those shares if they
Mhm.
want to cash out early before, say, an IPO or something happens. So that gives them a little bit more options for liquidity if they don't want to wait, say, 20 years or, or however many years for something like that to happen. So there is a
Yeah.
lot more exit options in today's world than there used to be for startups.
And it's funny that the aftermarket there is funny in a way, because if you think about it, you typically can't sell a safe, right? But or shares, options of a business that's still private. But what you're essentially selling to those third parties is the rights to them once a liquidity event takes place. In a lot of cases, it'll be something where we'll give you $100,000 now for
Yeah.
the what is the current fair market value of $150,000, but then you have to deliver that asset within 90 days of a liquidity event. But what I find funny about that is a safe itself is a promise for future equity. So they're essentially just selling a
Promise for a
promise
promise.
on a promise, right? And so there's actually other cases where that would go 3 layers deep. And at that point, the concept of how derivative it is can seem like Inception.
It's like futures.
Yeah, exactly. But yeah, that's a very good point. And actually, it's timely too. There are a lot more liquidity options now than there were even just a few years ago.